Welcome to Drill Down Earnings. We have quarterly results out from Texas Instruments. It's one of the 50 most important companies in technology covered by Epistrophy Capital Research and their chief market strategist. That's me, Cory Johnson. We look at these companies because they matter so much in the world of technology, and Texas Instruments is the largest producer of chips in America. So right important right there. Q2 earnings, a beat or a miss is how Wall Street looks at it. And yes, it was a beat, so it was better than expectations. But let's dig in a little bit deeper. The Street was looking for $4.3 billion in revenues and $1.33 in earnings per share. They got better than that, but I think what's really important here is the direction. Revenue growth is back for this company. It's back in double digits. Now, Wall Street did not like the guidance here, and the stock was off a lot. We'll take a look at that in a second. But if you look at the growth of this company, they really have turned from putting up negative quarter after quarter after quarter, kind of in the post-pandemic period, when they had a lot of sales in the pandemic, really low inventories, customers built up inventories, then that got to be a problem. Well, look, they're starting to work through that a little bit, double-digit growth. I think that's pretty good. And their margins, which were getting worse, are only at 35% operating profit margin, but that's better than it's been. It was better than a year ago. So the slide is abating in margins for this company. Now, when you think about their business, they used to give us a lot more detail about what they were selling into. They tell us anecdotally about what's happening selling into electronics, selling into automobiles, which is a huge part of their business. But we know that their analog chips were 78% of their business here. Embedded processing, which has not done well in the last few years, is 15% of revenues, other stuff 7%. But the analog business is growing strong, 18% growth on a year-over-year basis. So again, when revenues are up 16%, your biggest business is up 18%. What's going on here? Well, let's dig into some of the areas. So industrial segment writ large for this company, it's getting better, but it's not better yet. The same with automotive. Automotive actually was not good for these guys in this quarter, and they flagged that on the conference call. Again, not without specific numbers, but telling us automotive is just not where it was, and suggesting that tariffs were part of the problem there. We're going to hear from the CEO about that in just a moment here. And they're spending a lot of money building out in CapEx with a real focus on building out their CapEx capacities here. But the embedded processing business, which had been suffering, as I said, has actually made a turnaround here and seems to have bottomed here, 10% on a year-over-year basis. It's dragging down the overall results because it's not growing as fast as the analog business, but it is growing, and that's good news. Another thing I want to call out, these guys are serial buyers of their stock. They are buying back their stock, reducing the share count. And if you look back just the last 3 years, you see their earnings per share were about 1% better than they would have been had it not been for that buyback. Nonetheless, the market hated these numbers. They hated the guidance for next quarter, which was still a little bit above my numbers, but it was below Wall Street's number. The margin numbers below Wall Street's number, and the commentary in the conference call not super positive, resulted in the stock falling 11% in after hours, putting the stock, that was up 4% for the last year, a big bounce off of April lows, but 4% for the last year, now below those numbers, not good. But the business overall showing some signs of life that were not evident in recent quarters. A cyclical upturn seems to be underway, but slowly. And I think that automotive is really something to call out here. CEO Haviv Ilan was asked about that on the conference call. Here's what he had to say.
Automotive peaked for us in the third quarter of 2023. And in the last, I would say, sixth quarter, a little bit up, a little bit down, but hovering around a certain level of high single digits down versus that number. So, and think about the automotive customers. They those who ship into the US, they have tariffs to deal with. So I don't think they want to. I think they're being cautious right now, and I think the orders we get is only when they really need it. I don't think there is any inventory replenishment there, not only at the OEMs, but also at the tier one level. So everything is almost real time. And we'll just, we have, our lead times are so low, and most of our automotive customers are on consignment. So we just get it real time. So we haven't seen yet the recovery. But remember, industrial peaked in the third quarter of 22, and we saw the recovery starting in Q4 of 24. So you can argue that automotive could be maybe a year later if you just keep the same, duration. So, is it going to be time in the second half of the year? We'll just have to see real time.
He mentioned that inventory. We can see that in the balance sheet. If you look at their days of inventory, which is say how much inventory they have on their shelves, forget what the customers have, it's a little bit better than last quarter, but 234 days of inventory. It's not the real lows they had after the pandemic, and we wouldn't expect that, but it's not a lot better. It's not a super bullish sign for Texas Instruments. But what's it all mean? What's your big drill down earnings takeaway? What's the one number that tells us a whole lot? Well, Texas Instruments Q2 earnings, a good quarter, not a great quarter. The guidance was disappointing to Wall Street, but when you look at the numbers, their essential summary shows you a 16% rise in revenues. That's pretty good for this business that was really shrinking in the last couple of years after the pandemic here, and a decent quarter. But the one number that tells you a whole lot about Texas Instruments, if you want to remember one thing here, is that their analog business was up 18% in a year-over-year business, and that's the number that matters the most. Embedded processing also up 10% on a year-over-year basis. Both of their biggest businesses growing again, maybe not up to the expectations of Wall Street, but not too bad. All right, thanks for checking out Drill Down Earnings. Please subscribe to us. Hit that subscribe button and check us out on the socials on X at Cory TV and on TikTok, Instagram, and YouTube at Drill Down Pod.